Hello and welcome to this very special edition of Women's Wednesday powered by Mira Asset Investment Managers India. I'm Kavita and today we are going to talk about multi-factor strategies or navigating through multi-factor strategies for women. I have with me Siddharth Srivastava, Head ETF Product and Fund Manager. Hi and welcome to this discussion. And so we've discussed earlier smart beta strategies for women, but then what do we actually mean by factor investing and what do we mean by multi-factor investing?
Yeah, so factor investing is basically targeting a certain behavior, certain characteristic, for example, a low volatility or a quality or a momentum factor, where you not only select companies based on these factors, but you also weigh company based on these factors. For example, if there's a large cap based low volatility index, it will pick companies which are having less volatility, which means their price is more stable, and they will assign weightage also in the portfolio based on lesser volatility. So company with lesser volatility will get higher weightage.
Right.
So basically there is a shift where in simple products like Nifty 50, you are picking companies based on size and you are assigning weightages also based on size. So largest company in India gets higher weightages.
Right.
In case of factor based products, you are picking companies based on a certain factor and you are assigning weightage also which is influenced by that certain factor.
Right.
So by doing that, you are trying to create a product which mimics that behavior, which mimics that characteristics. A low vol fund will typically be more sturdy, more stable during market turmoils or in sideways market. Now, factors are cyclical,
Yeah.
right? Momentum works well in bull market. Value works well when markets are recovering after a fall like global financial crisis or post COVID. Low vol works better when there is markets are choppy. So to remove that or to take care of that comes multi-factor products, where you are trying to mix two or more factors in order to sorts of get best of multiple factors. So for example, if you mix quality with momentum, you are trying to capture the bull market but with a more sturdy group of companies.
Okay. How would you recommend women investors to navigate their strategies through this particular approach then?
So women are becoming increasingly savvy in terms of tech and in terms of capital markets, right?
Right.
We are seeing more and more women investors opening demat accounts, broking accounts. In our ETF itself, in Mira Asset, almost 20% of investors are female investors, right? And they are lapping up not only to these old age themes and safer investments like gold, Nifty 50, etc., but they are also keen on understanding about these smart beta. And as I've said, that these strategies cater to different behavior, exhibits different characteristics, and female investors, they sorts of associate themselves with in terms of doing several roles, right? Being responsible for themselves and for the families also. So they can take a call if they feel that they need to have a more stable portfolio. They can focus on low volatility or low volatility mix multi-factor product. And if they want to focus on momentum, they can pick out a momentum-based product. And if they want some stability, look at a multi-factor which has a momentum contribution to it, blended with a low vol or a quality.
So assuming that you already have a portfolio, okay, where you have invested in maybe a pure equity fund or maybe have a strategy where you have some hybrid also placed in your portfolio. Now in that kind of a portfolio, when should you have these kind of funds as an exposure? Or in terms of diversification, maybe if one wants to use, what should be the stage when you enter these strategies or when you have these strategies in your portfolio, and in what amount of exposure?
Okay, so I'll answer this via multiple points.
Sure.
So factor or multi-factor products should not be your first investment or a second investment. Your first, second, third investment should be plain vanilla core products like Nifty 50 or a hybrid or large cap or a flexi cap within equity domain if I'm talking about. You should only invest in factor or multi-factor product after understanding the nuances of that product, how that strategy is doing,
Okay.
and what that strategy is supposed to do in different market cycles, and whether your investment objective is aligned to that, right?
That's an
Because
important
that is
point.
very
That's
important.
very important.
And then if you understand that and you feel that, okay, there is a product called, let's say, momentum plus quality, and I want to take exposure in momentum factor, but I am also not very comfortable with momentum which are being shown by, let's say, not so sturdy companies, and I want a blend of quality also in my portfolio, then I can look at momentum and quality based product. So these are very sorts of informed call which any investor needs to make.
Okay.
Also, second point, which how people are using smart beta products is as a portfolio completion tool. For example, let's say typically you might have invested in only quality centric active fund managers, right? If your portfolio may be completely tilted towards let's say FMCG or private banks, or let's say large cap companies, etc., and you want to take that sorts of exposure to sectors which are trending right now, right? You can do that via investing in momentum based funds. So it also acts as a portfolio completion, that if you are having a very risky portfolio right now, add low vol. If you are having a very sorts of risk averse portfolio right now, and if you're comfortable, add momentum. So you can do all those sort of combination. You can create a multi-factor portfolio by yourself also.
Okay.
For example, what you can do is, okay, I'll target low vol and momentum together, and by doing 50-50 allocation, I'm having a risk averse investment in low vol, which is defensive company skewed, and I'm having a 50% allocation towards momentum, which is investing in trending sectors. And then one fine day, if you realize that next 1 year is going to be choppy in terms of markets because of valuations, because of headwind, geopolitical issues, whatever, you can increase your allocation to low vol, and you can reduce your allocations to momentum. And if you feel that markets are going to do well, you can do vice versa. So all those sort of combinations are sorts of getting very popular. So easy way to do it is to invest in a multi-factor fund. So there are quality plus momentum based fund, there are alpha plus low vol based fund, and do it, or do it by yourself.
What's the cost involved in investing these kind of funds?
So when it comes to passive are typically not very high cost, but typical range is, let's say, around 30 basis point to 60 basis point when I'm talking about ETFs.
We don't have any international exposure so far, or do we?
No, we don't have any international products as such which is also looking at smart beta as of now.
So when you talk about these strategies, they come into phases, right? Again, we are talking about helping women investors understand the markets really well. And over here, timing the market is a very common aspect, and everyone wants to do it. Any specific time when you should be placing these kind of strategies? I mean, you definitely explained that when the triggers are where the market might just go down, or we will be in a choppy territory, then you might want to have something like a low vol, etc. But that will be for a certain period as well. We cannot stay invested for long in it, or can we?
It actually gives you the flexibility. For example, if you are able to time the market well, if you are able to predict bull run or market choppiness, you can pick momentum or low volatility. And even if you don't do that, let's say you are not you're a great predictor in terms of, you're not Nostradamus, then what you can do is simply you can invest for at least one market cycle. For example,
That's right,
when we look at momentum, you need to stay invested for at least 2 to 3 good phases of market, and then only typically it gives you that alpha, right? Because you need to ride that uptrend, or rather a bull run of the market. So if you stay invested for 5-7 years, that is when we have seen that even in the long run, these alpha or low vol strategies have done well. In near term, you have to be obviously be able to take right calls. And if someone is not willing to take a call, they can obviously, as I mentioned, multi-factor removes that cyclicality.
Yeah.
So if you don't want to get worried about short-term volatility, let's say in momentum, then you can invest in a multi-factor product.
So just keep it simple.
Keep it
is
simple.
what multi-factor investing
Yes.
also means. Yeah.
So I'll not say keep it simple.
Okay.
I'll rather say that factor is bit complicated. Multi-factor just sorts of reduce the cyclicality in that complication. Yeah.
Okay, all right. All right, I think that will be all. Thank you so much for being on the show today. And we hope that you get these smart strategies and right on your way ahead to becoming a smart investor. Thank you so much for watching. Goodbye.